Hey everyone, it's Ben Hardy, and in today's video, we're gonna be talking about car payments and more specifically, what your payment should be on a used car or a new car. I know the video title most likely has what's a payment on a new car, but this will also pertain to used vehicles as well. So in the first part of the video, I'm just gonna give you guys like a really quick mathematical equation that you can use to basically figure out what your car payment might be. And then I'll kind of get a little bit more into depth after that in terms of helping you determine what your car payment actually will be. So for a really quick shortcut to figure out how much your car payment will be, a really easy mathematical equation to use is basically just take every $5,000 that you're going to finance on a vehicle and put that as $100 a month as a payment. So just as a quick example, if a car that I'm buying is $15,000 and I'm gonna finance $15,000, then with this quick, just like how much my payment might be, just go, okay, the payment's gonna be about 300 bucks a month. So hopefully that makes sense. That's just like a really quick way to do it. Obviously there's a lot of stuff that goes into determining a car payment, but if you just use that quick equation, that'll give you at least a ballpark number, so then you can kind of know if something's gonna fit in your budget or not. So you go, okay, well this car is $40,000. Okay, well that's gonna be $800 a month. Can I afford $800? No, I cannot. So I probably need to look at a car that's less than $40,000. So it just gives you a really quick way to look into things, so then you can kind of just very quickly gauge, hey, can I afford this or can I not afford this? Now let's get into the specifics of what actually determines a car payment. So the first thing that determines how much your car payment is going to be is how big the loan amount is. The bigger the loan, the bigger the payment. Pretty straightforward. Then your credit score is also going to come into place. So if you have a higher credit score, you're going to be able to get a lower interest rate, which means you'll have a lower payment. And the other thing that comes into effect is how much money you put down. This not only affects how much you finance, which would in turn affect how much the payment is, because if you finance less, you have a lower payment. It also can affect the interest rate as well. So let's kind of get into those things for the next section of the video. So first off, in terms of loan amount, this is something that some people seem to have a misconception on, but I feel like it's pretty straightforward, so I'm not gonna spend too much time on this. Just know that if you buy a more expensive car and you take out a bigger loan, you're gonna have a bigger payment. It's just math, right? Math doesn't lie, it's just numbers. So just literally, if you take away all the interest, you take away everything except for the term, then you go, okay, well, if I buy a $10,000 car, or sorry, finance a $10,000 car, if I finance that 10 grand, well, that 10 grand is going to be a certain payment, right? In our last equation, that'd be about 200 bucks a month. Well, if I go and finance a $50,000 car, the payment should be higher because the amount that you're financing, especially if it's over the same term, right? Of course it's going to be a higher payment because it's over the same loan term. Again, this seems pretty straightforward and self-explanatory, but I've noticed that there's some confusion on this where people think that they can somehow get a more expensive car at a lower payment. And obviously if you go for a longer term, then that can happen, but you're going for a longer term. So even though you're getting a lower payment, you're still paying more for the car. So yeah, you finance more money, you'll have a bigger payment. End of story. Now, the thing that people really should focus a little bit more on is going to be your own personal credit score. So having a higher credit score helps you get a lower payment because you'll get a lower interest rate. If you have a lower interest rate, you're paying less to the bank, so you're paying less overall. Now, the reason that a credit score is really important to a lender is basically a credit score is a representation on your ability to pay back on your credit. So if you're not very good at paying back on your credit, you're not gonna have a good credit score. So when the lender looks at lending out to you, then they're gonna go, this person's at a higher risk of defaulting on a payment, which means we might have to repo a car, which means we might have to lose a whole lot of money on loaning them out money, which the whole point of a lender loaning money is for them to make money. Obviously, lenders do have a threshold where they kind of expect a certain percentage of their customers to have repos. They kind of build that into their interest rates and everything. But at the same time, they want to try to avoid that. So they're obviously going to avoid really risky credit situations. And people with high credit scores, they're just going to give them lower interest rates and they're going to give them easier approvals overall. Now, I've made a ton of videos on how to improve your credit score and all that, but I'll kind of get into some tips and everything regarding the automotive side. So first off, you just want to have auto loans. If you've never had an auto loan, it's going to be hard to get the best interest rate possible. It's not impossible, it just makes things a little bit more difficult. So having auto loans on a regular basis actually helps out, but not only having auto loans, completely paying those auto loans off really helps out, because from a credit perspective, if they show that you have an auto loan and you pay on it for 1, 2, 3, 4, 5, whatever, however many years, and then you completely pay it off, then they go, this person is consistent, they can make all their payments, they can pay things off, and so they're a very low risk to us. So not only are we going to give them a lower interest rate, but we're just going to give them a loan because we know that they're going to pay that money back. We're going to be able to make our money. Everyone's going to be happy. And so that's kind of how lenders look at it. And so from the auto loan perspective, you want to have auto loans and you want to pay them off. You never want to miss a payment. That's a huge thing, is never miss a payment. And then making like extra payments, that's always a good thing, even if it's not like a full amount. So like, let's say that your payment is $400 a month, and instead of paying, you know, people go, oh, you have to pay double payment, pay $800 a month. Well, maybe you don't have that fit in your budget, but maybe you can pay $450. Maybe you can pay $500. That little extra amount helps out a ton. People talk about this with mortgages all the time, where how they paid, you know, an extra $100, $200 a month on their mortgage, and then they ended up paying it off, you know, 5-10 years earlier, depending on how much their mortgage amount was, right? But the same applies to auto loans. So that's kind of how to improve your auto credit, which will help you get a lower interest rate, which will help you get a lower payment. The next thing that is really important is going to be down payment on a car. Now, the reason that down payment's important is it lowers the amount that you're taking out a loan for. So the lower the amount that you take out a loan for, the lower your payment, right? From our first point, if you have a smaller loan, you have a smaller payment. It's just math. Now, the other thing that's a huge benefit is it shows commitment from you to the lender. And why this is so important is, again, with the whole topic of repossessions and people missing payments, late payments, all that kind of stuff, if someone puts a massive amount of money down, or just any money down, period, on a car, that shows that you're committed and you're less likely to default in a payment. Like, let's say that I went and bought a brand new truck and it was $50,000, and I went and put 20 grand down. Now, I just gave up $20,000. That's a lot of money. And do you think that I'm going to go and then not make my payments? Because if I didn't make my payments, then I'm going to be out $20,000, right? So it just shows more commitment to the lender. And then obviously you're less likely to miss a payment because you're out that money up front. And typically people that put a lot of money down are usually really good at saving, and they're better with their finances in general. And so they're less likely to default on a payment. And so that's why money down can help, because it not only can help with an approval, but it can help lower your interest rate as well, because your loan to value will be better, and we'll kind of get into that now. Now, loan to value is pretty straightforward. Basically what it is the amount that you're taking out a loan for versus the value of the car. So for our example, let's just say that you go and buy a car that's valued at $1,000. But let's say that you decide to finance some of the fees associated with that car. So instead of taking out a loan for $1,000, you take out a loan for $1,100. Well, your loan to value is 110%, saying that you're taking out a loan that is 110% of the value of the car. So your loan is bigger than what the car is worth, which obviously is a negative to a lender, because they're going, oh, well, if we have to repo this car, then we're going to be upside down in this car, so it's not good for us. Versus if you go the other perspective, let's say that you put enough money down to where you're taking out a loan of $900 on this imaginary $1,000 car. And now that means that your loan to value is 90%. So you're taking out a loan that's worth 90% of the value of the car. So let's say that the car gets repoed. Well, then the lender's not in such a bad situation, because now they have this car where they only loaned out 90% of what it's worth, and they can sell it for $1,000, whatever, and they can get out and get ahead in our imaginary situation, right? And so really all this is showing is that lenders are very risk adverse, and the lower risk that they have to take, the better, and that means you'll get a better interest rate overall. That's really what I'm trying to put or hit home with this point, is just if you put money down, it shows less risk to the lender, so then you'll get a lower interest rate. And the next point, I want to talk about risk. Sorry about the weird lighting, but the sun is starting to set, and this video took longer to film than I expected because, well, I made a lot of mistakes. I can't talk today. But regardless, the whole thing about risk is something that's really important, and I hope that you guys kind of got that throughout the entire duration of today's video, is that lenders want to take the least amount of risks possible because they want to guarantee on their money. I know that some people might think that lenders like giving people really high interest rates. Obviously, a higher interest rate means they make more money, but higher interest rates are associated with people that don't have the best credit, which means that they are a higher risk to the lender, which means the lender has a lower chance of getting their money. A lender would rather give someone a lower interest rate and have a guarantee on their money than give someone an astronomically high interest rate and know that that person's probably going to have to give up that vehicle back to the lender in a repossession or whatever, because they're not going to make all of their payments. This is what I was talking about, guys. I just cannot talk today. But what I'm trying to say is, the less risky you are to a lender, the better the interest rate you're going to get and the better your payment is going to get. And so that's what you really need to look at it as. I'm sure at this point you guys are probably going, well, how do I determine what my more exact payment is with all that information now? So obviously you need to know what your credit score is, and the best way to do this, go get a pre-approval, and not only will they tell you what your credit score is, but they can typically tell you what interest rates you qualify for. But let's say that you don't want to get your credit pulled. An easier way to do that if you don't want to get your credit pulled is simply know how much money you're going to put down. So say I'm going to put $1,000 down, and at least know roughly what your credit's like. Most people kind of know this. You kind of know how much debt you have compared to what your income is. Most people know if they're good at paying stuff or if they're not. If you're really good at paying stuff and you have very low debt compared to how much money you're making, then typically your credit score is going to be a lot higher versus someone that has a lot of debt and they miss payments, all that kind of stuff. It's just how credit works. So at least know a rough idea of where your credit's around. And there are some car loan calculators where you can put like a credit range in. Just understand this isn't going to be 100% accurate, but it's going to be more accurate than the first amount, right, that I gave you guys where I said, okay, $5,000 is $100 a month. This will be a little bit more finely tuned. But obviously, if you want to get the most accurate representation of what your payment would be, you got to get a pre-approval from a lender so they can give you an exact interest rate that your credit qualifies for. But basically, just take the amount that you're going to get a loan on and take what your credit score is, take what your down payment is, put that all together, and that'll determine what your payment's going to be. So now with all this information being understood, let's kind of just give a quick example for what a payment would be on a new car. So the average price of a new car in the US right now is about $38,000. If we do our first example of just how to get a payment really quick, then we know that $38,000 is pretty close to $40,000. So then we go, boom, every $5,000 is $100, so $38,000 is about $800 a month. But then if we go and we look at national interest rates right now, a pretty low interest rate, I've seen interest rates that are a little bit lower than this, but what I typically see advertised right now is like 2.99%. I see that pretty much everywhere. Sometimes I see like 3.5%. It's always somewhere in that range. And that's just what when researching this for this video, that's kind of what I saw. If you get 2.99% for like 60 months, $38,000, it's about $680 a month. For 72 months at 2.99%, it's about $580 a month-ish, so a little bit, about $100 less. And then if you go out to 84 months, then you're looking at about $500 a month roughly. And so really what you can do is you can look at the advertised interest rates if you have really good credit and if the debt to income is really good, and on top of that, if the loan to value is also going to be good. And that'll kind of give you a little bit of a better idea. I mean, I personally do it all the time before I actually buy cars. What I'll basically do is I know what the interest rates I've gotten on previous cars, like this Raptor, for example. I've got 2.99% on it. The Supra, I think it's about the same. I think it's like 2.99% as well. And so now I go, okay, well, if I decide to buy another car, the interest rate's probably gonna be 2.99%. So then when I go out and calculate my payment, I go, okay, well, this loan's for 72 months. The Supra's for 72 months. I'll probably do 72 months again. I put in 2.99%. I put in about how much money I'm gonna put down on the car, and I go, okay, this is my payment. I feel like comfortable making this payment, or no, I don't feel comfortable making this payment, so I'm not gonna buy the car. And that's kind of how I run things mentally, is based off of what I've gotten in past auto loans. But the thing I also understand is interest rates change all the time, so I might not get that 2.99%, or maybe I'll get a lower interest rate. You never know until you know. Man, I feel like that video was like all over the place. Sorry about that, but it's a video nonetheless. And I'm still trying to like figure out these just like talking type videos. I'm not necessarily the best at them, but I'll get better as time goes on. But again, just to quickly summarize things, your payment on a brand new car is gonna be determined by a bunch of factors: your credit, how much money you put down, and then how big the auto loan is. And again, just understand, the bigger the loan you take, the bigger the payment. The more money you put down, the better your interest rate, and the lower your payment is going to be, the better your credit is, the better your payment, or the lower your payment's going to be because you're going to get a lower interest rate. All these factors come together. So if you want the ideal payment, make sure that you have good credit. Make sure you put a decent amount of money down so you can get the best interest rate, and just make sure you shop as well with the interest rate so you kind of see what other lenders are offering so you can get the lowest interest rate. Because just because you use a lender to, you know, store your money with them doesn't necessarily mean that lender is going to be the best one from an interest rate perspective. I'm lucky enough that I have that situation where the lender that I use for my money is also the lender I use for auto loans, but I understand there's a lot of people that aren't necessarily that lucky and they have to go to other lenders. It just depends. And so, yeah, I want you guys down in the comment section below to suggest further topics. Like always, if you're stopping for the first time, please subscribe, and I'll see all of you in the next video.